Hey, Mark Henry A here. Morning. Oh, wow. Hmm. Yeah, to a certain network, I was always in agreement. I could put that up before, or not, well, on Black Friday. Corrected you on Black Friday. That's actually the truth. Just to make sure people have a reminder not to spend too much. Sure, they'll still kill me. But, I think just one thing to go over. Oh, Mary, love you. I didn't get that out already. Hope you're doing well. I'm sure you are. But they want me to explain the stock market. Wow. Why not just all the working components of the space shuttle? That's fine. Both have their intricacies. Let's explain. First of all, what is a stock? A stock is ownership technically, into a company or corporation. And that's why it's called a share. Well, because you share in the ownership of the company or corporation. The percentage, to get into the more complex nature of the beast, it depends on how many shares there are total. They call it outstanding. Which, okay, that's fine. That means how many shares are owned by individuals, companies, corporations, because yes, they can actually invest as well. Companies and corporations can. How many shares are total out, period, for the general public to own. And how many you own. And that determines your percentage of ownership. Okay, that's accomplished. What drives a stock price to go up or down? First, it has to be listed. That's with an exchange. Or over the counter market. Over the counter markets in NASDAQ. For the most part, that is correct. That's 99% correct. Let's just go with that. I'm not going to discuss penny stocks. That's the last one, and I'm not getting into those at all. Okay, so first of all, it has to be publicly held. That means it was IPO'd, initial public offering. That's where it's first offered to the public. And that's it. That's what an IPO is. It's just initial public offering. The price of the stock is determined by, well, first of all, it's what the public determines its value to be. And that's controlled by people buying it and people selling it. And that's it. That's what determines the actual market price. And that's driven by what their earnings are, for the most part, and any assets they hold, intangible assets that they hold in-house. So if they're sitting on a bunch of cash, then you know that stock's worth money. Or if they cashed out of some bonds and then they're sitting on cash, it's all put out of those bonds, then usually the price will go up a little bit because it's all cash now. And there's not that risk of anything to do with the bond. But it's based on earnings. And also rise in the stock is based on anything that could positively affect those earnings. So say they're actually going to come out with a new product. It can be anything. If it's good, a good product, and seeing that it will sell, for the most part, then the stock price goes up. It could be that it could be that a product is coming to the market and they thought, wow, it looks pretty good, and all of a sudden no one wants it. I'm just like, oh, not good enough. Seen it before. And then people get concerned because they spent money on bringing that, which is R&D, that product to the market, and the share price goes down. It could be that they don't have anything coming to the market and people have concerns about the company failing. The stock price goes down. It could be that they're going into a period of research and development and they know they're going to use a lot of capital or cash. Another term for cash. But they're going to use a lot of capital and the share price goes down. Because there's no telling if the product's going to be half decent or not. That's why. Just going through everything. Now, the only other area of interest to a stock price that could adjust the price is regulation. It could mean that there are new laws passed or they're removing old laws and new laws being passed that makes it so that the product sells more, can be sold, period, or that they can bring a new product to the market like never before because of deregulation or change in regulation. It could be overregulation brought into play and the stock price goes down. We have concerns, so we're going to regulate at the federal level or even state level. And the price goes down. That's it. That explains roughly how the markets move and why they move and what a stock is. You might ask, can you have a stock on any company or corporation? Basically, as long as it's legally allowed to be a company or corporation, that means they're not breaking the law anywhere whatsoever. They're not bringing an illegal product to the market that should never be brought to the market. And yeah, it can be, as long as it meets certain criteria, then it can actually be listed. That's what their sales are, how much cash they have, and there's other criteria, but that roughly explains it. Yeah. As long as it's a legal business, then yeah, you can actually IPO the sucker, so to speak, and I explain what an IPO is. That's it. That's rough investing in a nutshell. You get into more complex things, investment strategies, like hedging, short selling, and as you get in the last part, which is short-term, medium-term, and long-term gains. That's where the stock price goes up really quick and you sell at short-term gains. Medium-term and short-term, 2-3 months. 6 months, medium-term. A year, long-term. And that's just done for taxation purposes. And you ask me, what do I get involved with? For the most part, long-term gains. And that's the truth. I usually invest for a year and a half, even 2 years, strategy-wise. That's it. I've gone over most of the rookie information about the stock market, and I hope that explains to people. This is Mark Anthony signing off. Thanks. Bye. I might love you.